All right, why don't we kick off? So thank you very much for joining. So this is our third of 5 income investing dividend related webinars. So we've got another one next Tuesday and then one next Tuesday night, which is exciting. But anyway, thanks for joining. I'm Mark Lamonica. I look after the individual investor business for Morningstar here in Australia. And yeah, we're going to talk about other benefits from dividend investing today. But first, our housekeeping item. Anything you hear today is general advice. I obviously don't know anything about you, so I can't offer personal advice. Would, however, like questions. So if you have questions, if you want to put anything in the Q&A or the chat, I will get to those as we come along. And of course, you can email me at mark.lamonica1@morningstar.com. The email address is in the invite if you have any questions after the webinar. So let's get started. So we're going to talk about benefits from investing in dividend-paying shares that is not necessarily just the benefit of course, getting a dividend. So we spent some time on that. Excuse me. But dividend-paying shares also have other attributes which can be beneficial for investors. So we're going to cover those today. And I believe we have 5 of them. So we'll go through each one of these in detail. One, we'll look at total returns. So dividends do make a very meaningful contribution to total return. So even if you're not necessarily just searching for that income aspect of things, you're probably investing because you do want to earn a high return. So we'll explore that a little bit. We're going to look at dividends as a relative valuation measure. So we'll explain what that means and compare that to the traditional approach. We're going to talk about how dividend paying shares oftentimes have lower volatility, may indicate lower business risk, explain what that means and why that is often the case. We'll talk about tax advantages. Everyone loves to talk about tax. We're kind of getting up to the end of the financial year in a couple months, so tax is important. We'll talk a little bit about tax. And then finally, we'll talk about downside protection during market turmoil. So similar to that lower volatility, but we'll specifically look at periods where the market is not doing very well. All right, so why don't we start out with dividends make a meaningful contribution to total return. So if you are an investor, of course, you get returns from 2 different sources. You get returns, of course, from price appreciation. So that's when the share you own goes up in price, which of course we all like. But you, of course, also get returns from dividends. And dividends can be a big portion of that. And, that capital gain we can really break down. So that's the price appreciation. That kind of breaks down into 2 different categories. So remember, that's changes in valuation levels. So somebody's willing to pay more for a dollar of earnings. Of course, that's good. It means the share price will go up. And it's also from earnings growth. But a portion of those earnings, of course, get paid to us in dividends. And we're going to concentrate on that portion. So we've got a couple different stats on here. So if we go back to the year 2000, even if we go back before as well, but I want to use relatively recent history, the majority of ASX 200 returns have come from dividends. So over 50% of those returns have come from dividends. If we go all the way back, where we've got a little bit better data, looking at the S&P 500 in the US, about 40% of the total return can be attributed to dividends, reinvesting dividends, the power of compounding. So we've got 2 different charts on here. Start with this one right here. So this is looking at the US. You can probably read growth of $10,000 between 1960 through 2021. So where do you get? Of course, if you invest $10,000 and you do not get any dividends, of course, you only get $795,000, which still seems pretty good, but we're close to $5 million if we reinvest dividends. Now, obviously, anytime we are breaking down the components of a return, dividends are part of it. So this isn't necessarily looking at non-dividend payers versus dividend payers, but we'll look at that in a second. You can see a lot of that return is coming from dividends, and especially a lot of the power of that return is coming from reinvesting dividends. So whether that's a direct reinvestment, whether that's a DRIP, where you're automatically taking that dividend and buying more shares, or if you're simply accumulating dividends over time and reinvesting them in whatever you want. So if you're going out there buying completely different shares with the dividends, we can still see that we've got that effect from dividends, and especially that compounding, right? So that you're not only growing, hopefully, the price of your portfolio, the prices of the shares in your portfolio, you're also, of course, buying more shares. So it means it's just accelerating that impact of compounding, that earning a return on a return. So something we talked a little bit about last week. So you can see pretty big difference. Same thing if we go over slightly shorter time period. So this S&P ASX accumulation index is the one that is including dividends in it. And you can see the S&P ASX 200 without dividends, you can see substantially higher, right? So almost 3 times as high if we are including dividends. So dividends are obviously very, very important. They're an important component to total returns. And we can break this down a little bit. So both of these charts are looking at the US, and we want to look at dividend contribution during different periods of time. Now, remember, the US is slightly different. There's just better data and more data, so it's easier to look at that. And we'll point out some of the differences between the US and Australia. So basically what you can see here is, I believe this is gray. I've got issues with colors, but right here is the amount of the return that comes from price appreciation. And then we can see the amount that comes from dividends. So what you can see is there are a lot of differences across decades. Now, a couple of things to point out, and we'll talk more about downside protection coming up. This says NA, the 2000s right there. That's because the S&P 500 actually had a negative return during that decade. So that decade involved a couple of events. Started out with the dot-com bust, and then of course we had the global financial crisis to kind of finish the decade out. So not a very good time period for investors, but you'll see that you actually still had a positive return if you included dividends. But of course, we don't have a percentage of that because it's more than 100%. Because the return was actually negative. And then if we go back to the 70s, now remember the 70s were not a great period for investors. You had high inflation, you had interest rates being risen, then paused, and they rose again to try to combat that high inflation. So it wasn't a great time to invest, and some of that might sound familiar from what you're reading in the newspaper right now. But you can see, especially in these decades where you do have low returns, a huge contribution comes from dividends. And then when we get into periods where there is higher overall returns and the market gets a little bit frothy and speculative, we can see these in the 2020s, obviously not a full decade there. You can see the dividend contribution actually does reduce. So depending upon the investing environment, dividends can play a bigger or smaller role. Now, Australia is a little bit different, of course, than the US, because Australia pays higher dividends, so companies have higher payout rates. The overall yield of the ASX 200 is significantly higher, so almost twice as high, or a little more than twice as high as what we see in the US, but still big impact overall. So what you're going to see is less variability, I suspect. I couldn't find the data, but what I would expect to see is less variability in the percentage that dividends make up over the ASX, because you've got that higher yield, because you have very different industries than companies that trade in the US. But still, once again, a big contributor to returns. The only other thing I'd point out is that in periods like today, now obviously when there's high inflation, almost every company is going to struggle, because what companies are struggling with is they're struggling with the ability to pass on those price increases to consumers, and consumers get increasingly wary about continual price increases. So generally what a company can do, which we've talked about before, is a company can sneak a couple by you, right? Where you don't necessarily notice that prices are going up. You don't necessarily notice if there's shrinkage in what you're actually getting from that company, smaller serving sizes and things like that. But over time, as inflation becomes more deeply ingrained, as it starts to hit consumers more, you do see that impact just because people notice that more. And obviously, as their spending becomes constrained under inflation, they're more cognizant of what they're spending money on, and they're making those trade-offs. And so they're either switching to lower price brands, or they're just completely making trade-offs, not spending money on something so they can support things that are more important to them. But one of the benefits of dividends, as opposed to something like a bond, which generally pay fixed rates, is that, of course, that dividend can still grow. So even if a company is not able to pass along all of those cost increases to consumers, and we want to look for companies that can in this environment, even if they're not able to do it all, they still can generally pass through some. And what that means is, of course, they still have the ability to raise that dividend, which is why in an inflationary time period where bonds, for example, that are paying fixed rates can be terrible investments because you're locked into a yield, which becomes less and less from an after inflation perspective. You don't have that necessarily with dividends. But with all of this discussion around dividends, it's really, really important to find, of course, the right companies. And we'll go through that a little bit, although it's not a focus of today. So what this chart right here is a study that was done by Wellington Management, which is an investment manager, pretty famous investment manager, mostly works with institutions. And what they did is they divided up dividend paying shares into 5 different cohorts. So basically, we've got all these different quintiles. The first quintile is the highest yielding shares that pay a dividend. If we get back to this 5th quintile, it is the lowest 20% from a yield perspective of shares. And what you can see over here is the amount of time that a share in this quintile has outperformed the overall S&P 500. So one thing I would sit there and say is if you start looking at these percentages across here, and without me being able to do the math right away, what you can see is most of these dividend payers actually outperform the S&P 500. So that's the first thing you notice here. No matter where they were paying a dividend, they outperform that overall index. The other thing to notice here is where is the sweet spot? It's really the second quintile. And this is just, and we've said this over and over and over again this month, becoming an income investor is not simply just picking out the shares with the highest yield. What we really want over time is obviously the sustainability of that dividend. And we also want to make sure that that dividend is growing. So sometimes some of the slightly lower, so the 20 to 40% quintile right here, sorry about that, the 60 to 80%, if we're looking at the highest yields, that is an area where you kind of have that sweet spot between a yield and growth. And that's where you see the highest outperformance. This isn't blindly picking the highest yields. It's going in and doing some analysis on that. So something important to remember. And then the other thing that's really important, of course, as I said, is when you are identifying dividend shares to invest in, and obviously you're not going to get this right all the time, it's really focusing on those dividend payers that are going to be able to continue to raise that dividend and avoiding the ones that have to cut that dividend. So that's really where we're looking for sustainability. So what they've done is they basically grouped dividend payers into a couple different categories. Now there's overlap, of course. Dividend payers is everything, right? So just remember that. That's important. So dividend payers include dividend growers and initiators. So a grower, of course, is a company that is increasing its dividend. An initiator is a company that has never paid a dividend before and started paying a dividend. No change in dividend policy. So basically that dividend is flat. It is not being raised. We've got non-payers, as we can see. And then we've got cutters and eliminators, so dividends that are reduced or completely eliminated. And so what this is doing is it's going back between, obviously, a long time period, 73 and 2021, and it's looking at a couple different things. So we'll explain some of the terms on here. Returns should be hopefully something that most people understand. So you can see obviously the highest returns were dividend growers and initiators, which is unsurprising. And this equal weighted S&P 500 is what they're using as the index here. So you can see outperformed, dividend payers outperformed. No change in dividend policy, so we do see underperformance there. Of course, a lot more than people that did not pay dividends. That's where we're looking at that outperformance on that previous slide. But what you really want to avoid, of course, is cutters and eliminators. Now, once again, I do want to point out that there are some differences in the US market and the Aussie market that you need to understand when looking at this data. So generally what Australian companies will do, because they have higher payout ratios, because dividends are more popular here in Australia, what they will generally do is they will have a set dividend payout policy. And that dividend will vary across years. So very simply, if somebody sits there and says, I'm going to pay out 75% of my earnings in dividends, and let's say you're in a cyclical industry like the mining industry, well, sometimes those dividends can be very high. And then the company's pretty comfortable if those profits come down with then reducing that dividend amount and maintaining that payout. Now, you see that less in the US. So you have lower payout rates. You have less companies that pay dividends, but generally companies will try to stick to that dividend and not cut it because it's such a bad signaling mechanism to the market. So there is more effort put into maintaining a dividend, and a lot of that is from not raising that payout rate too much. So remember, payout rate is the percentage of earnings that are paid out. The higher you get that to the earnings, the less you're able to withstand any sort of earnings volatility. So just something to keep in mind when we look at that. So beta. So very simply, what beta represents is we are looking at how a individual share price performs related to the overall market. So the overall market is represented by this equal weighted S&P 500 index. It, of course, has a beta of 1. So what that simply means is, because it's the market, if the market goes up 10%, of course, this equal weighted S&P 500 index will go up 10%. And then when we're looking at betas of other things in comparison to that market, something below 1 will indicate that it goes up less than the overall market, and of course falls less than the overall market when it goes down. So very simply, a beta of 0.88 right here indicates that if the market went up 10%, you would expect those shares, and historically those shares have gone up 8.8%. Same thing on the downside. If the market falls 10%, those shares would go down 8.8%. And so people use beta to look at volatility. Basically, the lower beta share you have, the less volatility you're going to have as the market bounces around. Whereas you can see cutters and eliminators, non-dividend payers, those betas over 1 means that you're going to get swings to the upside when the market's going up and swings to the downside when the market's going down. Another measure of volatility, we're going to talk about this one a lot today, so I'll spend a minute on it, is standard deviation. So basically, standard deviation looks at the variability of returns. So very simply, what we're doing is we're finding the average return, and we're looking at how one of these cohorts compares to that average return. So standard deviation, without going through all the math, basically just means the higher the standard deviation is, the more you could see swings in price. So what that means is on the downside and the upside, you're going to get more swings with a higher standard deviation. So yeah, without going through all of the details around the math there, that's what we're looking at there. So what you're seeing, and you're not supposed to see this, and we talked about this during last week's webinar, what you're supposed to see, investment theory teaches us that the more variability in returns. So for example, shares will always have higher standard deviations than bonds, way higher than cash. What you're supposed to see, and this is how really risk is measured and volatility from an academic standpoint, what you're supposed to see is with larger swings in prices, you're supposed to see higher returns. So you're taking on that risk as an investor that you're going to see those large swings in prices, and your reward that you get should be higher overall returns. But what you can see is that if you go and you look at these top two sections, you look at dividends growers and initiators and dividend payers, you are actually getting higher overall returns than the market with less volatility, which is interesting. So I'll get back to a point we're going to make a little bit later about potential downside protection and less volatility. So this is kind of the sweet spot of investing, right? So this bad thing, and volatility isn't necessarily bad for long-term investors, because who cares what something bounces around in if you're looking out 20 years. But volatility, this perceived bad thing about investing, is muted in these cases, and you're getting the good thing. You're getting higher overall returns. All right, so I'll pause. There's a couple questions. So Alec is asking, what measurements criteria are used to calculate beta? Okay, so beta is always something that's calculated against an index. So what we're looking at is we're looking at over whatever time period we're looking at. So in this period between 1973 and 2021, we're looking at how the index performed versus how either an individual share performed or how a group of shares, which is what we're looking at on this chart, performed. So remember that the beta, you have to have a beta of 1 to compare it to. That has to be the market, right? So in this case, very simply, if we went back to 1973 and we took a share, an individual company, or if we took a group of companies, and let's say over that time period, the market went up an average of 10% a year, and this share went up an average of 12% a year. So that would be a 1.2 beta. Now, remember, we're looking historically. So all of these statistical measures, beta and standard deviation, are looking at historic market conditions. So anything could, of course, happen. And what we want when we're looking at any statistical measure around volatility and risk is we want as much data as possible. Because if you go and you look at the beta of 1 year, or you look at the standard deviation of 1 year, well, you can calculate that. That's not a great look at the market because it's a very short time period. So once again, just like past performance and anything else that we always say in disclaimers is not indicative of what's going to happen in the future, this isn't necessarily indicative. What this is showing you is that over that time period, we did see lower volatility with dividend growers and initiators and just dividend payers in general. All right, so Jeffrey's asking, please explain beta ratio. So hopefully I explained that. If anyone has other questions on that, please let me know. But you can find beta and you can find standard deviation all over the place. So we've of course got it on our website that you can look at. So it just can be an indication. Well, it is an indication that historically things were less volatile or more volatile, but obviously anything could happen in the future. A little caveat. All right. Dividends may be a better relative valuation measure than the traditional approach. Okay, let's talk for a second about relative valuation. And I do these every once in a while around how to value a share. So the way that shares are valued by professionals is generally through something called a DCF, a discounted cash flow model. And what that basically means is a couple of things. Number one, as investors, or there's a couple of principles behind it. Number one, as investors, we don't care about the past. Now, the past can inform what we think might happen in the future. But if I buy a share today, or if I bought it 10 years ago, the only thing that really matters around what that matters to me about the company and the company's performance is how it performs into the future. Now, the issue with this, of course, is that the future is unknowable. And so anytime you are doing a valuation, you're, of course, predicting what's going to happen in the future, for a lack of a better word for it. So to really value a share, what we need to do is we need to estimate out those cash flows that the company will generate in the future. And then we need to discount them back to the present day. And we discount them back to the present day because of the principle that $1 today is worth more than $1 in the future. So think about that. Obviously, that's a lot more predictable. If your mate comes up to you and says, I'll give you $50 today, or I'll give you $50 in a year, what are you going to do? Well, you're going to take the money today. Anything could happen, of course, in the future. As we see in an inflationary environment, that $50 is just simply worth less in the future. Because of that, when we are estimating out cash flows into the future, we need to discount them. All right, so there's lots of different ways you can discount them. And if anyone wants a copy of a webinar where I go through a spreadsheet and boringly, or hopefully somewhat excitingly, explain how to create a discounted cash flow model, I can do that. So that's the way that people value shares, is the way they value anything, right? Anything that involves cash flows, that's the way that's valued. Basically estimating what they're going to be in the future, whether that's a project at work, you're trying to get a project funded at work. What are they going to ask you? Okay, well, how much money is this going to make the company in the future? So that's how almost everything is valued. But a relative valuation measure is simply when we're comparing two things. So one of the most famous things is the price to earnings ratio. Price to earnings ratio is literally just the two. We're dividing the price that the company's trading at. Let's say this company's trading at $20, and we're looking at the earnings that it has either made historically or is expected to make in the next year. So we're looking at very short time periods. So that's whether we're looking at a price to earnings ratio or forward price to earnings ratio, where we're looking at those estimates for earnings. Now, a price to earnings ratio will really tell you nothing in isolation. So I could sit there and say, oh, this thing's trading for 15 times earnings or 20 times earnings or 25 times earnings. Really tells you nothing because there's all sorts of different attributes that go into companies. And a huge one, once again, because we only care about the future, the huge one is growth, right? What do I care that something's trading for right now? If I'm investing for a 10-year period, what I really care about is how fast those earnings grow, right? Those are the principles that are around a discounted cash flow model. So a price earnings ratio doesn't tell you anything by itself, but it can be used to compare to other things. And that's the concept of a relative valuation measure, because then I can start making statements. Company A is cheaper than company B because company A is trading for a price earnings ratio of 15. Company B is trading for 20. So I can make that statement. It's cheaper. Maybe it should be cheaper. Not saying if that's a good or bad thing, all sorts of things that go into that, but I can make that statement. I can also make a statement when I compare a company to an overall index. If the ASX 200 is trading for 20 times earnings and a company is trading for 10 times earnings, I can say definitively that company is cheaper than the market. Once again, it could be cheaper than the market for very good reasons. It doesn't really necessarily give you a view into the future without analyzing the company and the overall market. And it can also let me compare a current time period or historic time period to some other historic time period. So I can say the market is cheap relative to what it's been historically. So if it's trading for 20 times earnings and it averaged 40 times earnings over the past 20 years, I can say the market's cheap. Now, maybe there's reasons it should be cheap, right? Because there's all different things that go into that. So that's really why it's a relative valuation measure. And people look at different things. So, traditionally, we go back to, the 1930s, price to book value was a huge relative valuation measure. So book value just represents the assets that the company has minus its liabilities. Price to book isn't used anymore because companies have changed. They have less physical assets. They have less factories. And now that we're, in the knowledge economy, you don't need a factory necessarily to make money. You just need a bunch of people sitting there with computers. So price to book has fallen out of favor, but price to earnings is still used a lot. Price to sales is sometimes used. So we're looking at revenue then, not earnings. You've got all these relative valuation measures, but one relative valuation measure is yield. So what is a company yielding from a dividend? So that's simply dividing the dividend from the previous 12 months with the price the company is trading for. So a high yield indicates that dividend's pretty high versus the price. A low yield indicates the opposite. So what I did is I went back to 2000 and I took the S&P 500 earnings. So this is the aggregate earnings of those 500 companies in the S&P 500. Then I took the S&P 500 dividends every single year and just looked at that year-on-year change, right? So here we go. In 2001, dividends dropped by 2% on an aggregate level. Earnings dropped 51%. So you can see some pretty big differences. And then what I did is I calculated the standard deviation of both of those. So once again, that's looking at the variability of returns. So what was the average return, or in this case, the average year-on-year change in dividends and earnings? So I took that and then I looked at where do we plot each one of those returns against that average? How does it compare to the average? So what you can see is there is a huge difference between the two of them. So standard deviation of earnings on the S&P 500, 62%. Remember, once again, the numbers don't necessarily matter. What we want to look at is the comparison here. So what this means is that the dividends bounced around in price in terms of variabilities of the percentage differences in dividends year to year was significantly less than what it was for earnings. And there's a lot of reasons for this. And basically, I'll go through a couple of them, but earnings can vary a lot on a year-to-year basis. One reason they can is because of earnings management. So earnings management is the nice way of saying the non-illegal way of manipulating earnings. Now you have to remember that earnings, of course, are an accounting measure, and companies do manage those earnings. And they manage those earnings because they don't want to disappoint investors. And there's lots of different ways that they do that. So, there's certainly this notion that if the company's not doing well, they will, of course, decide that, okay, this is going to be a terrible year anyway. Let's throw a bunch of things into that year. Right? So we might as well just have this horrible washout year, and that'll put us in a better situation in the future. And really, if we start looking at that, we can think of the ways that companies can manage those earnings. And a lot of it is around expenses. And so the very simple example of this is I can decide to recognize an expense, to go out there and spend money on something. In Australia's case, I can decide to do that on June 30th, or I can decide to do that on July 1st. Is it going to make a difference? Not really, right? But that is going to have a huge impact on my earnings, right? Because of these expenses. So that's one thing that a lot of companies do. And there are ways to do it around revenue. There's ways to do it around debt. There's all these little things that companies can do to manipulate earnings a little bit. The other thing, of course, is that a lot of companies do have to go through these one-off investments. So a one-off investment could be a restructure where you're taking a charge. A one-off investment could be deciding, okay, well, I'm going to go through and renovate all of my stores this year. All these different things that impact earnings, but aren't necessarily representative of how the company is actually doing. So you do have a lot of variability in earnings, and there's also just the cyclical nature of earnings. So anyone who's listened to the podcast or watched this before knows that we always like looking at the CAPE if we're looking at a PE ratio. So a cyclically adjusted, I can speak, price to earnings ratio that looks back over 10 years and averages those earnings together. So what it does is it smooths out all that natural cyclicality. But you don't really get that if you're looking at a regular price to earnings ratio. And so dividend and using yield as a relative valuation measure can be a really effective way of trying to figure out if a company is cheap or not. Once again, you need to understand the company and understand why. But I could sit there and say, well, this company is trading at a 3% yield. Historically, it's been trading at a 1.5% yield. And because those bounce around less, because those dividends bounce around less, it can be an effective way of looking at it. So just remember that yield is something you can use. Dividend policy can obviously change. Dividends can change, but they change a lot less than earnings. And I think a lot of people get very confused without really understanding what's happening with the company if they're just looking at that price to earnings ratio. So just something to think about. Remember, it's another tool that you have as an investor to go in there if you're not going to be an analyst, not going to go in there and study every little bit about the company, something you can go in and look at. And earnings can be very, very confusing. So if anyone reads earnings reports, there's all sorts of different types of earnings that are always cited in those reports. So whether it's EBITDA, whether it's a special charge that some people back out, all this different stuff and noise goes into an earnings statement. But a dividend's a dividend, right? It's getting paid out. It is cash. The company can't declare a dividend and then not pay it, right? So what that means is that that dividend is actual cash expenditure by a company. And you can see that that cash expenditure is generally the company looking forward, of course, and trying to figure out what can we pay based on real business conditions, rather than some sort of managed earnings or managed press releases, right, where they're trying to massage the information that they put out there. So it's something else to think about. Once again, something that can go into an investor toolkit. All right. So an anonymous attendee, we'll go through a couple of questions, asked regarding PE ratio, doesn't it change on a daily basis compared to the dividend payment ratio? Okay, so let's just make sure we're getting our terms right here. So a PE does change on a daily basis because the price changes, right? So that's something that is going to change with every little price fluctuation. Now, a dividend yield will also change on a daily basis. So there is, of course, that as well. But you said dividend payout ratio. So the amount of earnings that they pay out, that will not change because they're both based on historic numbers, right? So we're looking at dividends paid out over the previous 12 months, and we're looking at earnings over the last 12 months. So that will not change until the company either reports earnings or declares a dividend. So that's when that payout ratio will change. But just remember, yields will change on a daily basis. But what we're looking for when we look at a relative valuation level is we're looking at, has the price changed a lot to make this company either expensive or cheap? And that's really what we're trying to figure out. It's kind of shortcuts trying to figure that out. So that price movement and the changing nature of those two things does matter because that's what we're looking at. So Rodney says, do companies in general smooth out their dividends like LICs often do? So LICs are a little bit different. A company can smooth out their dividends. So companies can make all sorts of decisions, right? So very simply, a company could have a very good year and earn a bunch of money and say, okay, well, we're not going to put it into the dividend. We'll just stick it in the bank. Hopefully not Silicon Valley Bank. Stick it in the bank, and then we'll just pay out a higher dividend next year. So companies can choose to do that. They don't often smooth out dividends like that. But yes, it can be a policy of a company, but I don't think that's necessarily a bad thing. And then in reference to LICs, so LICs smooth out, LIC is technically a company, right? Just from like a legal structure. LICs are a little bit different because LICs don't do anything. At the end of the day, what a LIC does is invests in other companies. So what some LICs do to smooth out that dividend income that comes out of them is they are just taking reserves from dividends, right? Remember, they're not making money in any other way. They're simply a group of investments that the LIC has decided on. So they will build up reserves. So instead of giving it back to the owners of the LIC, they'll just build up the reserve. And then, of course, they can pay that out in the future. So that's the way a LIC will smooth out dividends. So a little bit different than a company because they're not actually out there. They don't have all the choices a company has, right? A company can go out there with any profits they make. They can buy back shares. They can invest in the business. They can give it away in bonuses to their employees. They can buy a building. There's all sorts of things that a company can do that a LIC can't. So yeah, just a little bit different. So Michael says, is there a way in Morningstar to search for quality companies paying dividends of 5% plus and having a low beta. I'll see the point of investing in these times by getting good dividends, but taking a 20 to 30% drop in capital value. Yes, you certainly don't want to do that. So yeah, there are stats, and certainly in our screener, you can screen for companies that meet that. The only thing I would say is that, well, two things. Remember with the beta. So beta is historic. So different things can happen in the future. The other thing around a beta is, remember that if you have a beta of 0.9, all right, so you'd sit there and say, okay, that's low, that's below 1. Well, if the market goes down 40%, you're not going to get a good outcome likely. So just remember, you can still have those big drops in capital value. It might drop less than the overall market, but doesn't necessarily mean that's a good thing. So yeah, just something to remember for that. Lisa says, is it still possible to use dividend reinvesting when a portfolio is used for retirement income? How could this idea be navigated? Okay. Yeah, I mean, it depends what you mean by retirement income, Lisa. Lisa sent me a lovely picture of one of her alpacas today, by the way. Depends what you mean by retirement income. So yes, in theory, you could continue to reinvest your dividends when you're in retirement. The issue you would run into is, of course, you need money to take out. So you would have to sell shares at a certain point. But technically, yes, you can reinvest and then just decide to go in there and harvest your positions, basically sell off your positions to fund that withdrawal. Now, not a lot of people do that. But yeah, technically you could. All right, so Anthony says, should be aware of market distortions that can directly affect PE, e.g. sentiment. Events like 2008, COVID, for example, events like 2008 and COVID. Is there a ratio that compares PE directly against dividends? What are the PE highs and lows that would cause an investor to look deeply into the company and ask why? What is the average PE? Okay, yeah, so we can go back. I don't have the figures in front of me, but we could, of course, go back and look at the average PE that markets have traded at. What I would say about PE that we need to be careful about is that valuation is driven a lot by interest rates. When interest rates are really low, investors in general are willing to pay more for shares. When interest rates go up, generally those valuation levels go down. So when we're looking at PE against historic ratios, we need to just be cognizant of that, right? Because it's not an apples to apples comparison. And the other thing I'd say is that if you look at price to earnings, if you look at valuation, right? So the level of price to earnings that somebody would be willing to pay, it has gone up over time. So yes, if we go back and look at an average, back to, there's data, at least on the US market, back till, the late 1800s, we can go back and look at that. But we have to realize that the PEs that things were trading for back then, when you were picking up companies at 3-4 times earnings, just don't exist right now. Doesn't mean we can't go back there at some point, but that those P's have creeped up over time. And in terms of looking at a ratio that compares P directly against dividends, we could do the same thing. Now, dividend yields have come down over time, right? Because as valuations go up, as people are willing to pay more for companies, those yields have generally gone down. So yeah, you have all that kind of noise in there, but I think if you take that historic perspective, you can do that. But what I tend to do is I look at more recent times, whatever you want to call that. So whether it's going back and looking at the market since 2000, maybe creeping into the 90s, if you want to go back a little bit more, looking at that sort of more recent data sets where interest rates basically were at least somewhere around the same level, even though they've gone up a lot, still not as high as they have been since the 2000s. I think looking at those more recent times is a good way to compare those. All right, so Stephanus has a question. Is the dividend paid to investor based on the ex-dividend date or the payout date? So basically, what we're looking at here is the concept is there's a couple important dates that come up when you're dealing with dividends. So there's a declaration date. So remember, a dividend is a choice. So every single time a company pays a dividend, they declare it. It's not like a bond where there's a written out interest schedule that they will pay you unless the bond issuer defaults. Dividend is a choice every single time that somebody pays it. So the declaration date is, of course, when they come out, the company comes out and says, we will pay a dividend. And what they'll announce on that declaration date is they'll announce the X date. So basically when the share trades X dividend. And what that X date represents is that anyone that owns the share on the X date is entitled to the dividend. So they may say, what is it, the 21st of March? They may say the 21st of March is the X date. So if you own the shares, then you'll get the dividend. So even if you sell it a couple days later and you do not own the company on the pay date, you still get the dividend. That's why share prices drop by the dividend amount on that X date. And then the pay date is when they actually pay you. So it's when the money shows up in your bank account if you were a shareholder on the X date. So those are some important dates to remember around dividends. Anonymous attendee says, trend in higher earnings from 2000 to 2021 reflect a growth measurement in the companies. Yeah, absolutely. So if we go back here and look at earnings, this is earnings growth, right? If we go back and look at all the S&P 500 companies, made $86.45 a share in 2000. They made $213.51 in 2021. So that is pure earnings growth. So remember, when we look at the components of a return for shareholders, earnings growth is one of them. So we want to see earnings growth over time. And then what you can see is the dividends and what they grew as well. So if you want to look at the payout ratio, basically we're dividing those dividends by those earnings. See how much of the earnings were paid out. So yeah, you can see even though they bounced around a lot and had some really poor years, right? Especially around the global financial crisis, around the dot-com bubble bursting, around COVID right here. You can see we've had big dips in earnings in certain years, but yeah, overall really strong growth is the trend that we see. All right, those are some good questions. So keep them coming if you have any more. Got a couple more slides to get through. All right. Dividend-paying shares may have lower volatility, may indicate lower business risk and stronger financial strength of a company. And this goes back to the fact that, of course, a dividend is a choice. And it's a choice the company management can make. But, of course, that choice is dictated to by the financial strength of the company. It's dictated to by the earnings that a company has. It's dictated by the prospects a company has in front of them. And one of the criticisms around dividends, which we'll talk about next week, but one of the criticisms around dividends is that, of course, by giving money to your shareholders, you don't have as much to invest in the growth of the company. Now, I don't completely buy that. I mean, it is true, of course, but also just like handing over money to executives to do what they want results in a lot of private jets and fancy vanity projects and buying other companies and a lot of stuff that destroys shareholder value. But it is true that the more money that is paid out to shareholders, the less that's available to invest and grow that business, assuming you believe that management can grow that business. And this is sort of the Warren Buffett argument. So, right, Berkshire Hathaway has never paid a dividend. And Warren Buffett's answer is pretty simple. He says, what is the best use of the money that's generated by my company? Well, it's to give it to me and his team to invest in other companies or to grow the business. So he's basically saying that I am better at this than you are. And so over the long term, you will benefit more from me having more money to invest than just giving it to you so you can do whatever you want with it. Now, if you're Warren Buffett, that probably makes a lot of sense. He's one of the greatest investors ever. For most management, I'm not really sure that it is. But anyway, if we think about that, we think about sort of growth opportunities, we think about the other uses of dividends, what that generally means is that companies, when they reach a certain level of maturity, that's when they start paying dividends or start raising their dividend significantly. And the conventional wisdom behind this is that if you're a small company and you're a startup, you don't have the financial resources of a large company. You hopefully are growing very quickly, right? That's why you're a startup. So what they're doing is taking as much cash as possible and reinvesting it back in the business, whether that is hiring more employees so they can grow, doing research and development so they can create better products. And this does make a lot of sense. So you tend to get higher dividends from more mature companies. You tend to get them from larger companies, right? Where those growth prospects aren't as great. And you tend to, of course, get them paid out by companies that are in better financial condition because they are larger companies, more mature companies, and also have the financial strength to pay out a dividend. So they're not sitting around worried about how to pay their bills, how to pay back their debt holders. So in general, that's what you're going to get out of dividends. Now remember, this is the aggregate. This does not mean that that every single company pays a dividend falls into that. All of these things can be proxies for lower business risk. So remember, we talk a lot about on here that different companies have different levels of risk. Now that can be a good or bad thing depending upon what you're looking for, but very simply, a large mature company that's been around for a very long time, has established products, et cetera, has lower business risk than a startup. Now that startup could turn into Microsoft or Google or something tremendous like that and make everybody very wealthy, but most startups fail, right? So that's higher business risk. It's higher business risk whether this product takes off and catches on. It's higher business risk if that company actually prospers. Now, you might want to invest in that, and that's fine. Just go in with your eyes wide open. There's much less business risk that Coca-Cola will go out of business. Doesn't mean it won't happen, of course, but that risk is lower. So what this can indicate, of course, is depending upon where you're comfortable investing and what you're trying to do, are you trying to hit a home run or, I guess, cricket, my limited cricket knowledge, you're trying to hit a 6 or you're trying to hit a 1, right? So bigger reward, higher risk, lower reward, lower risk. So it lets you go through and figure out, okay, what's the kind of companies that I want to invest in? The other thing that we need to think about with dividends is as an investor, I am putting an outlay into a company, right? So I'm going out there and saying, I'm going to buy $10,000 worth of shares. I want a return at a certain point, right? Whether I'm going to sell those shares in 30 years or not, I do want a return. And if you're getting a dividend every year, what that does is it basically shortens that payback period, if you think about it, right? So if I go out there and invest $10,000 in a company and it's paying me $1,000 a year in dividends, I just bank those dividends, or even I take those dividends and invest it in something else, that means in 10 years I should get my investment back, right? So what it is it's sort of shortening that time period, which is lowering your risk as an investor as well. And of course, anytime with the company, you could own a company, there's probably a lot of people that owned Credit Suisse for decades and decades and decades, and maybe everything looked great for a while, but then when what happened to the company happens to the company, well, all those returns are wiped out. If you had been collecting dividends the whole time, at least you've got something. So something to think about in terms of kind of business risk and your risk as an investor. Quickly go through these. I know we have a couple other questions. Tax advantages, I'm sure I'm preaching to the choir here, but very simply, because of franking credits, you get a tax advantage for taking returns, dividends versus capital gains. So pretty simple. And that, of course, means that they're realized capital gains. It means you're selling something. But pretty simple. They're taxed at the same rate, whether it's in super, whether it's out of super, different rates between the two, obviously, but they're taxed at the same rate, capital gains, dividends, as long as they're long-term capital gains, by the way. But of course, you're getting franking credits back if you're investing in shares. That franking credits, it lowers your effective tax rate. So something that should be obvious, but something to think about, a tax advantage. The other thing is, of course, the fact, and this sort of Lisa's question is, if you are trying to fund withdrawals from your portfolio with capital gains, so meaning you are choosing when to sell the investments in your portfolio, there's some risks associated with that in terms of sequencing risk, right? That if you need money you need money to live, and no matter what you have to sell shares in order to fund that, well, that's not a great thing to do if the market is down significantly, right? It'd be a time that you wouldn't want to sell. Dividends, of course, can lessen that. So it provides more choice, right? It provides choice in how you can extract money from your portfolio. All right, the last one, very quickly. And this once again shows the power of finding companies that grow their dividends. So the dividend aristocrats, once again, this is looking at the S&P 500, looking at the US. So dividend aristocrats are companies that have, I think it's 20 years, have raised their dividends for every year for 20 years. High dividend index, just looking at those highest yielding shares. And then, of course, this S&P Composite 1500 is the 1,500 largest companies in the US. So you can see in down months, so anytime the market goes down, the S&P 1500, what you can see is that, well, you're getting downside protection, both from the dividend aristocrats and from these high dividend yields, right? So that's why it offers this downside protection against market turmoil. Well, if we go back and we look between 1999 and 2022, the 15 worst months over that, roughly 23-year time period. We go back and we look at that, well, you can see even bigger differences from companies that are able to grow their dividend, which, as we demonstrated before, is something we want to look at, versus the overall index. But the high dividend yield did even worse. So once again, it's not just any dividends, it's trying to look for companies that are able to grow their dividend. Of course, the fact that they're able to do that means good things are happening. Their earnings are likely growing as well. They're a company that's still growing. So those are all very good things that you're looking for. But it does show, you pick the right dividend payers, how you can give yourself some downside protection. And just remember, maybe this doesn't look like a huge number, a little over 2%, but that's a month, right? So remember, these 15 worst months, the market went down over 9.5% in a month. Well, you're doing pretty well if you're only down 7.3%. All right, so we've got a couple other questions just to finish this thing up. So is it worth comparing your... So Joseph says, is it worth comparing your price to dividend against your original price against the current previous year's price to dividend, see if your dividend payment is increasing? Yeah, so I mean, I think there's two different things that you're saying there. We want to look at the overall dividend payments increasing. We could, of course, just look at the dividends paid per share. I think what you're really looking for is yield, right? Dividend against your original price. I look at this a lot. So what I look at is not just the dividend yield is something I own, but also yield versus cost, which is yield versus original price. And the reason I like to look at that is it also shows the power of growing dividends, right? In that example where I talked about $10,000 investment getting $1,000 dividends, well, hey, it's a great thing when that dividend keeps growing and all of a sudden maybe you're getting $5,000 a year, not all of a sudden, but over a long period of time. Well, that means you have basically a 50% yield against that original cost basis, right? So you're trying to figure out, when I made this investment, what am I yielding off of that? So yeah, I do that all the time, Joseph. So I do think that's a good thing. So Ross says, can you provide TSRs for the dividend categories where you show dividends, beta, and standard deviations? Yeah, if you shoot me an email, I can get that to you, Ross. Eric says that capital gain is halved before the taxes applied, assuming the share is held longer than a year. Is the tax on capital gain still more than a dividend? Yeah, I don't. What I was looking at is just the marginal tax rate there, Eric. So maybe I just don't understand your question, or yeah, maybe I just don't understand your question. All right. So Nanisman Tendi says, do I have a take-home message for today's webinar? Yeah, I mean, the take-home message is pretty simple. There are obviously reasons why you would want to invest simply for income, but there's also a lot of other attributes that a lot of investors find very valuable that you can see with dividend shares besides just that income. So all the things I listed, hopefully a better tax outcome, lower volatility, downside protection, a company that has lower business risk. So what I would say is that it's more than simply the dividend that's getting paid. It's also the way that companies that pay dividends can impact your portfolio. So yeah, that's the take home, that it's more positive than simply collecting that income. Last couple of comments in here is Morningstar have a list of the best dividend shares on the ASX. We do that, our analysts think. So Sally, if you email me, I can get that to you. It's not paying out a dividend. Company's decision the same as reinvesting the dividend. It's not, right? So remember, the company is going to pay you the dividend no matter what, or if they decide to. Whether you reinvest the dividend is completely your choice. So it's just what you want to do with the cash. Anyway, I think we've made it to the end, but thank you. So a couple of people that had questions, just email me, mark.lamonica1@morningstar.com, and I will see everyone next Tuesday.
This video has been prepared for clients of Morningstar Australasia Proprietary Limited and or New Zealand wholesale clients of Morningstar Research Limited. Any general advice has been provided without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.